Hi everyone, and welcome to Nuggets, the official Troygold podcast. With Nuggets, we aim to arm you, the physical gold owner, with the financial wisdom to understand not only the ins and outs of gold investing, but also to provide you with enough insight to navigate the current economic environment. This podcast is an audio extension of our popular gold commentary, also dubbed Nuggets, sent via email to subscribers twice a week. You can also subscribe to this email Nuggets on our website at www.troygold.app or by becoming a Troygold user in downloading the Troygold app on the Apple app or Google Play stores. I'm Dane Viljoen, the co-founder of Troygold, and this is episode 1, and it's called Gold Whipsawed by the Fed and Inflation. This episode is recorded on Wednesday, the 3rd of March, 2021. Let's get to it. First off, the scoreboard. US equity markets have rebounded today and are all slightly up. The S&P is up about 70 basis points at 3,895, and the Nasdaq is also, and the Dow is also up just shy of 1%. Crude is just up above $60 after a good run the past few weeks, and gold is down $8 today, sitting at about 1725 USD. In Rand terms, the gold price is sitting at 25,782. Today's recovery in equities markets are as a result of a Chinese banking regulator yesterday making a statement that he's very worried about risks emerging from bubbles in global financial markets. And this sparked fresh concerns about, the government tightening in China, and it spilled over to US and European markets that opened later. That being said, when we look at where all the action is at, it's basically mostly been in gold markets and the bond markets the past 2 weeks. Last week, we saw a sell-off in the bond markets, which very much lifted yields and impinged on gold. Although this was arguably overdone. And if we look at the US 10-year, what happened is the US 10-year government bond is effectively the risk-free asset, or US government bonds are risk-free assets for financial markets, and it spiked last week to about the 1.55% for the 10-year, and I think the 30-year was just under 2%. Sorry, a correction, just above 2%. The 30-year spiked to about 2.36% last week, and the 10-year to about 1.5% last week. They've both come down since then. They've come down to about 1.4 today, 1.4% on the US 10-year, and about 2.2% on the US 30-year. Now, this is important because of the effect that interest rates have, and especially these US government treasuries have on other financial assets, and gold specifically. Now, as we've said, gold has been sort of whipsawed by two opposing forces. We saw gold, for example, last week with the rising bond yields come down 8%, whereas this week gold attempted a recovery after last week's bashing, rising $20 to about $17.69 before succumbing to another wave of selling, and we've seen the gold price come down to about $17.20 this week as government bond yields, and it's all sort of mimicked government bond yields rising last week, then dropping. So gold increased, the gold price increased, and then the government bond yields have started ticking up again, and hence gold has come off a little bit again. So these intraday swings are what we would say are the result of a debate happening in markets. You have some investors assuming that the distribution of vaccines and the opening up of economies, along with unprecedented amounts of money printing by the monetary authorities or the central banks of the world, that these would result in renewed economic normality and growth. Effectively, when bond yields rise, they're betting that it's business as usual, things are recovering, that there will be healthy growth and hence healthy inflation in the economy, and that the US Fed will effectively, US Fed being the most powerful central bank, will have to tighten the reins to prevent too much inflation by raising the interest rates. So this is what we call the reflation school of thought, and it has been driving US government bond rates, which has been declining since effectively the 80s, but specifically since the COVID-19 pandemic last year. They've been at near zero levels And this uptick has been a result of this momentum of the inflation, reflation trade coming to financial markets, specifically equities. However, that's the one school of traders betting up equities market. So that's the one side. On the other side, you've got rather skittish investors who are not so convinced, and they're betting that regardless of the vaccines or the unprecedented amounts of money printing happening, that economies still have some unsound fundamentals, and that production output is not near where it will be or where it should be. So additionally, this side of the market is effectively anticipating that there will be an oncoming wave of historic levels of inflation. And so they're not so rosy, and what they're doing is that they are bargain hunting safe haven assets. So they're bargain hunting the dollar and trying to collect, sort of catch a good price. Whereas the former group are driving risk on assets like equities up, and they're selling bonds. So they're driving up bond yields and interest rates and driving down the price. Whereas the second group, buying traditional safe haven assets, US government bonds, gold, and the dollar. We've had quite a lot of volatility in those asset classes the past 2 weeks, and it's basically just this tug of war between these two schools of investors in the market. So when we look at gold specifically, and especially since it's had this inverse sort of reaction to bond yields, we have to ask the question, why is this such a dramatic player or catalyst to the direction of the gold price? Now, we've previously mentioned before that the main driver for gold is effectively real interest rates. So that's the nominal interest rate in the economy, taking into account the inflation of the economy. So, and why that's the case is if you're owning gold, if you're buying gold or saving in gold, gold is a money. So just like the $100 US bill, there's no yield on money. There's no interest rate on money. You have to borrow it out. You have to lend it out. You have to take risk. So you have to effectively issue a bond or buy a bond to get yield on that. So when you're foregoing that interest rate, there's an opportunity cost that you're letting go of. If you're just holding cash, US dollars, or if you're just holding gold, you're letting go, or you're foregoing the interest that you could be earning on bonds. And as a result, the risk-free type of bonds, or deemed risk-free type of bonds, which are US government bonds, US being the largest producer or largest economy in the world, has a huge impact on the direction of gold. So what we've seen in the past 2 weeks effectively is that the uptick in these US government bond yields is the main factor that's been pulling down the gold price. Now, when we take a bit of a longer-term perspective on gold, and we understand what's happened in the past year, when the COVID-19 pandemic hit in March 2020, gold went from about a 1,600 level to a new all-time high of just under $2,100 an ounce. And that was about a 25-26% increase. Since about August in 2020, so August, September, gold's been coming down as interest rates and bond yields have increased. So it's come down to about the 1720 mark, and that's about a 16% drop since its all-time highs. It's definitely still up in the past year, about 5-10%. But what we are seeing definitely is a testing time for gold. Getting back to our analogy of these two forces or opposed forces in the markets at the moment, the first one, or the reflation trade force, is effectively a bet on confidence that everything's going back to normal and nothing's untoward, and we'll go and we won't see, we won't have detrimental effects based on the actions that monetary authorities have taken. I mean, just to put into perspective, since the pandemic hit, the U.S. government printed and spent about $2.9 trillion, and the latest Biden administration is pushing for another $1.9 trillion spending package, or as they call it, a stimulus package, to try and stimulate consumer spending and therefore get activity going back in the economy. But as we know, the definition of inflation is increasing the money supply, and it always ends in the same way. It always has, and it always will. It will end in a rapid increase in inflation, which is effectively a saver's worst nightmare. So if you are holding fiat currency or government-issued paper tickets, you definitely don't want to be in fiat. That's, I think, the other side of the trade, or the other opposing force, which is the non-confidence force. And effectively, these people are saying, right, we've had unprecedented amounts of government money printing, running the printing presses as hard as they can. I think the US dollar, I think the stat is that there's about 37% of all US dollars in existence historically was printed in the last year. Now, that massive expansion in the monetary base will and has to have an effect on inflation prices. At the moment, though, US Fed Chairman Jerome Powell has said that because there's such a loss of employment and people are still relatively sedentary and not as active, we don't have the pent-up demand of consumers coming into the market. So we don't have the velocity of money or dollars circulating in the economy increasing as it normally would. And we haven't seen people come in, or consumers come in, with enough confidence to drive asset prices or to drive your staple prices and inflation up tremendously. But I think the house view in Troygold, obviously, we are sound money type people, and we believe that when you do inflate the monetary supply and you do start penalizing savers, then the result is always inflation, massive inflation, and you have a wealth transfer from the savers of the economy to the debtors of the economy. And the government is the largest debtor in any economy. So as a result, that is why we always recommend, and all peasants effectively, I think, I refer to Jim Rogers, who says, we're all, he's an old peasant and we're peasants. And one thing we do know is that when governments do what they do, and when there's a lot of money printing, and when there's a lot of uncertainty and volatility in the world, we look for gold, and we look to gold because it is the safe haven asset. And the question is, why is that the case? And the answer is effectively because it is the best store of value. Gold is, as we've mentioned earlier, gold is a money, so it can save value or purchasing power over time, and that's exactly what it's doing. That's exactly what it's there for. So we've seen that in the past year. It is the object or the asset of choice, or the money of choice, when there is shenanigans in world economies. Why we're very, very confident that the interest rates will remain near zero or will be brought down is that the US Fed has effectively come out and said that they need to keep interest rates near zero for long, and see no reason to stop their bond buying program or stop what they're doing in terms of money printing for the foreseeable future. So as a result, we have an unprecedented amount of sovereign debt. The world is stuck, or world governments are stuck with debt levels that they've never had before. The US has a debt to GDP ratio well over 100%. South Africa is sitting at, I think we've doubled our debt to GDP ratio in the past 10 years, from about 35 to 65, 70. And with Tito Mbowene's new speech, we will be increasing that within the next 5 years, I think, to about an 80, 90% level. And effectively, we have these monstrous sort of debtors in each economy, which is the state, and they just keep borrowing money, or needing to borrow money, to keep financing themselves. So when governments do borrow, they need to borrow sort of free money. So interest rates need to be near zero, as close to zero as possible, for it to be favorable, because then they can borrow more and they can spend more. And that's exactly what we're seeing happening. So we are quite confident that it's our view that there is a sovereign debt crisis brewing, that there is a lot of credit in the system, and that credit is in a bubble. Bonds are in a bubble. We like what Jim Rickards and Jim Rogers and Peter Schiff are saying about these speculative bubbles and bubbles that we're seeing happening all over, whether it's in crypto, whether it's in bonds, whether it's in equities markets, that they're effectively fueled by this large mass of liquidity and US dollars into the system. And because the governments globally are sitting on so much debt, then that fundamentally something has to break. Bubbles will pop. the central banks will do what they do, and they will keep interest rates at near zero, and they will push interest rates back down to near zero. And what we will see is a environment with high inflation. So inflation is coming, and we are not. It's definitely not smart, or it'll be nigh on impossible to make a call on when inflation comes. But as the markets open up, as spending starts coming back into the stream, as vaccines are getting rolled out, we will start seeing inflation tick up and potentially accelerate. And we think that everybody that's not in the safe haven asset of gold will experience a stripping out of their value in their savings, and declining standard of living. We will see standards go down, and we will see a wealth transfer from those that are in real assets in gold, or to those in real assets in gold from those that are holding paper tickets and debt. Join the conversation and link up with us by joining our Telegram community. The link will be in the bio, or following us on Twitter. Our handle is @TroygoldApp. Thank you again for listening. Keep stacking and keep saving in gold.